Okay, welcome back, everybody. We're now in session 5. The way we do this is that it keeps every replay individual. So people want to go back and watch various recordings, they can do so straight into the speaker they want to see, rather than having to scroll through a long list. So Alpesh, the real Alpesh is definitely here. We're going to bring you in right now. That's him pinging away as well in the background there. So we're going into the next two speakers. We're going to look more at stocks. We've had a lot of technical analysis this morning. I guess we've looked at the Elliott waves and the trends. We've looked at Jay Lacani's system. Taru as well has been talking to us about his all very technical. Now I guess we have a hedge fund manager, Alpesh Patel O.B.E, is going to tell us more about the stock markets. You're looking very smart, Alpesh. Good morning to you.
Thank you very much, Simon. I just had a call with the FT for a conference. I thought I'd better dress up, and of course, for all you good people, I thought I'd better dress up and get out of my pajamas.
We're very pleased to see you look very well, and thank you for joining us. What we can do first of all is change the screen, so we're looking at your screen, and then
I'll do that now.
Check if we can see and hear, and then we can get started.
Hopefully, you can all see and hear me, and see the screen.
Fantastic. We're looking at who you are on this webinar. Is that the right slide?
Yeah, exactly correct.
Yeah. Okay.
And you can see all that. You can hear me, and you should hopefully be able to see me as well.
Yeah, we can. Thank you.
Fantastic.
For those that I mean, not much introduction knowing. Alpesh, you and I have worked together for many years. We don't have long enough to talk about your whole background because, of course, you've done an incredible amount of work for entrepreneurs, running hedge fund, training and mentoring retail private investors. The list goes on. And currently, of course, your campaign for $1 million.com is your current project, where you are endeavoring to provide free education and teach up to 1 million people how to make better sense of their financial their finances.
Yeah,
their investments.
Teach them how to be better investors.
Yes.
And it's all sort of free education, takes on board everything that's in my books over my shoulder and all the sort of Financial Times columns, everything that I've written, and just puts it into a bunch of free content in the way people want it nowadays, which ranges everything from free online educational material, and they get a certificate at the end when they complete it, all the way to doing talks like this as well.
Well, I know that you've done it all. I mean, we're going more than 20 years ago, but you and I were doing technical analysis workshops around the UK. So you do short-term trading, but today I've asked you more specifically to talk about your thoughts on the stock market and the stocks. I know Tesla's reporting today. The US market is where you tend to keep most of your investments. So we look forward to hearing your thoughts on what's going on. Everybody, I remember him from BBC. There you go.
I'm on again on Friday morning. I'll be talking about bank stress tests. They've just emailed me, so I'll be on if you want to watch it again. I'll probably replay it on my LinkedIn on my view on the bank stress tests.
Awesome, fantastic. Alpesh, I know you're pushed for time, so I'm not going to take any more of it. I'll hand over to you. Thank you very much.
Thank you, and apologies anyone if you hear me sniffling and sounding sore-throated. I'm not well yet again, I'm afraid. Okay. Thanks, Kapil. I will be sure to raise that issue. So going on to this. Now, I've got to give the disclaimer for legal reasons. We're FCA regulated. We don't have a retail fund. I'm not here to sell you any funds. I'm not a broker. I'm not here to sell you any brokerage services or anything like that. However, I've got to say to you that it's not individual advice I'm giving you because I don't know your individual circumstances, and that's a requirement of the Financial Conduct Authority that I say that. But we are going to talk about forecasting stocks and which ones I like, which are in my SIP, my ISA, and how I think you should be picking stocks as well. So I'm going to teach you a bit more about fishing and give you some fish, as it were. Okay, this is the agenda. I'm going to give you some of the good news first, and then I'm going to give you some of the cautionary news as well. Like I said, how to pick stocks. What I like for I've got a 40% hurdle. If I don't think a stock's going to be able to achieve that for my US picks, then it won't make my portfolio, and it's 20% for the UK. Since 2004, my UK pick results have been audited. They've been followed and tracked independently by ShareScope. And I'm sorry to say, I only hit 18% for my UK picks. So I'm down by 2% since 2004, 18% per annum. Not every year, it's not a bank account. And the US, well, I can't take credit for how I do on the US, because the US, my US performance mimics how the two major indices do. So it mimics how the FTSE does compared to the US markets. And basically the US does twice as well as the UK on average over that period. So I've done twice as well for the US, but that's not because I'm better or anything for the US stocks. It's just that's how the market is. The market delivers roughly double on average over the long term for the US. So my 18%, you can see it on ShareScope's website if you wish, and they've tracked every single stock, every performance since 2004. I have no conflict of interest with you, so I just want to get that across. That's where our little offices are. We're on the, I wish we owned the building. We don't. We're on Brook Street. If you know where Selfridge is or the old US Embassy or Claridge is, we're just there. And we have a little room in there, and we're on the private equity and the hedge fund side. So not the retail client stuff. So why am I talking to retail investors? Well, I've been talking to retail investors, as Simon alluded, for decades and written books for retail investors. And I was a retail investor before I turned pro, let's put it that way. This is the past year's performance. You'll be familiar with it. We had a few hits in energy, healthcare, and so, well, what's this year going to look like? That's what the question is, and that's what you want to know. So I thought as a useful place, I thought I'd read the reports of all the major banks, not just those you see on there, but there was about 18 different banks whose reports I read, and see if there was anything they had in common. You might say, well, Alpesh, that was a useless exercise because they're bound to be wrong. Well, in which case I'd know to do the opposite, or you'd know to do the opposite. So let's start off with them and what they say. I've highlighted just a few things I'm going to talk to you about, and I'll also tell you where you can get all these reports for free in one place. Well, they're all agreed that GDP will be lower, but there might be a shallow recession. Goldman thinks they might avoid it. Interest rates, they think, will continue to rise and then pause there. It's not rocket science. I mean, everybody else on this call would have come to that conclusion. Equities, they say go for profits over growth. In other words, quality is what they're saying. So rather than just the momentum trades or the growth ones, go for the ones which are generating profits and, of course, are undervalued. Well, we're going to look at that in more detail. And one of the things I don't like about what the banks do is that they do try to gamble. Give me 1 second. I'm going to turn off Alexa. Sorry, there's background noise, music in the background. They think that they're going to try and gamble on growth or momentum or profits. What we're going to do to pick stocks, as we have ultimate freedom compared to them, is we're going to tick all those boxes, and I'm going to show you how you do that, so that should the market or CNBC decide or Goldman's decide that it's the year of value stocks, well, we'll have ticked that box. Or if they decide, actually, we're going to go for growth companies, well, we'll have ticked that box as well. Our stocks will be something which overlaps every single one of those categories. They believe many equities are undervalued. Well, they get paid a lot of money for coming up with crap like that. Can you believe it? They also think there's a focus on energy, healthcare, and financials for this year. I tend to disagree. I think energy might have peaked, and funnily enough, outside of financials, yes, but outside of financials and healthcare, and I had a good run in healthcare last year, so I'm not sure it's going to repeat itself so much, and I'll show you some of my picks. I actually think consumer cyclicals and tech will come back, those quality tech companies. Which ones? I'll show you in a second. And they also seem to be agreed overweight US, sorry, I spelled weight wrong, and underweight UK. Well, you may disagree with them, but let's go into the depths of all this. By the way, if you want to get all of those reports, and there's a whole bunch there, you can download all of the PDFs. They're on that link, alpeshpatel.com/links, which is also where you'll find my book to download completely for free. It's all free. All the stuff on there is completely free. Okay. So let's look at some of the good news. Let's look at some of the good news. Well, this is the good news. In a presidential cycle, the S&P, and I'll come to the UK stocks in a second, we should be looking at over 25%, 27%. I'm glad I don't have to persuade you of that. That's the data, apparently. October the 1st of year 2 to April the 30th. Well, we're sort of midway through that. That's the bumper returns. We're in the middle of it. Well, there's a bit of catching up to do, and it seems that the S&P is catching up at the moment to get to those kinds of returns. So that's some of the good news. You might distrust the good news, and I'll come to the bad and cautionary tales in a second before we all go nuts and buy a 2 times leveraged, or worse still, a 3 times leveraged S&P 500 ETF. And you can get 3 times leveraged exchange traded funds on the S&P. Don't do it because you might think, oh, I'll do that for the next 3 months, Alpesh, because if the market goes up 20%, I'll make 60. Doesn't quite work as easily as that, so don't do it. But before you get tempted, another piece of good news: if we do get a recession, actually, so the second half, you get quite a bump up on US stocks. They get strongly positive returns in the second half of recession. So some of us in the asset management industry might be thinking, yeah, bring the recession on. And that's because the market tends to look through it. So again, giving you the helicopter view first before we get into the specifics of stocks, that might not be too bad. Equally, you might say, well, hang on, Alpesh, you're forgetting something. Interest rates are rising. You're right. But when interest rates are rising, actually, again, the US markets tend not to do too poorly. Look at that. The annualized returns during periods of interest rate hikes tend to be positive. Well, that's good news. And there's something else which is not on the chart, which is to have 2 negative years in the US markets is very rare. So it should be a positive. Yeah, I know what you're thinking, but Alpesh, there's some really miserable people who think the markets are going to go lower. They might be right, but I'm starting off with the positive news. Now, this is where, before we turn to the negative or cautionary news, these are the S&P 500 forecasts. By the way, you may well want with this presentation your cell phone so you can take pictures, because when I give you some of the stock names, I'm not going to be able to dawdle on the slides for too long. So what does that tell you? Well, it tells you that there's a whole bunch of banks who can't even decide which direction the market's going to go, as is always the case. And the disparity between them is significant. At least if they all agree that it's going to go up, we'd have something to trade against or invest against, but they can't make their minds up. Does that mean they're all utterly useless? No, it means if you put all those names on a dartboard and throw a dart, occasionally you'll get it right, and so will they. But I'm not going to rely too much on what they're saying. This is what JP Morgan said with interest rate forecast. I think that looks sensible, looks pretty sensible. So there we are. Thanks, Liz, for the interest rate stuff. And that's what last year looked at. Before we get into this year and which markets I like, just out of interest, Kapil, you'll be particularly happy with that slide. The Indian markets performed the best. There's some argument that they're overvalued at the moment. And the NASDAQ composite fell a whopping 33%, but the Dow, interestingly, only fell 10%. Okay, but look at the UK. The UK was actually up, the FTSE 100 at least. That rarely happens where the UK is up and the US markets are down. It rarely happens over a 3-year cycle, almost never over a 5-year cycle. And over a 1-year cycle, it's still pretty rare. So we had our year in the sunshine. It won't happen again this year, I'm afraid. 10-year annualized return, 16% for the S&P. Can we get that again? It was a particularly good past 10 years. Chances are we can't. Even Warren Buffett, the ever optimist, says you're not getting that in the next 10 years. But that's not bad. The sad news is, and why you're on this webinar, is you, the average investor, as you can see on the screen there, and what I'm pointing at, you, the average investor, will only get half of that. Well, wait a minute. If the S&P, which is an index you could track, is getting 16.6% or did, and you're only getting half of that, what the hell's wrong with you? Well, one of the reasons is investors trade too much. They go in and out too much. Secondly, they give their money to fund managers. Those are the 2 main reasons that the research suggests. And by the way, if you're wondering who's this research from, only a Nobel Prize winner, Eugene Fama. Okay, that's where the research is from. But I'm going to stay with the US equities, not just the index, but I'm going to try and cherry pick some of the best stocks out of the index so I can outperform the index. That's my job. That's what I enjoy doing. You might say, after listening to me, forget about it. but I certainly know not to give it to a fund manager. I'll just track an index. That's entirely up to you. But I'm going to try and cherry pick. I'm going to teach you how to cherry pick in a second. Okay. Now, what you can see there is, yeah, out of all the major asset classes, actually, the American equities were doing better. For my SIP and ISA, most people don't even realize you can put US equities in the SIP and ISA. But you can. So I'm going to still keep looking at those. Okay, now, tale of two Jeremys, right? There's the miserable Jeremy Grantham, and then there's the optimistic Jeremy Siegel. Jeremy Siegel thinks we're on the cusp of a bull market. Jeremy Grantham thinks that's bull, that we're going to do that, and we're going to crash 50% this year. That doesn't mean they're both wrong or they're both need to go take medication, but we are in a confused area. So what does it actually look like? This is what it looks like at the moment. Now, I will look at the S&P 500 and I'll determine my risk appetite each month. Now, at the moment, I've been cautiously optimistic and I've bought some stocks. And I'll list which ones they are and why I bought them for my SIP, my ISA, my wife's SIP, and my son's junior ISA. Now, on the whole, last year, as you saw, we kept getting into that boundary. Now, at the moment, we seem to have, that's not enough of a breakout. We seem to have broken out above it. It's not enough. One of the things that I find the most useful to look at, if you've read any of my 18-odd books on investing, you'll know I do like to look at this, is the monthly MACD when I'm looking to invest. And I hold my investments for 12 months, and I'll come to those numbers in a second. And that seems to be flattening a little bit. So could we be on the cusp of another big bull rally? Well, it's more positive than it's been since the start of last year. That we would. Indeed, it's been more positive than since the bottom of COVID and that massive quantitative easing. Now, does that mean I'm full tilt bullish? No, it doesn't mean that. It means that I'm selectively buying some stocks, and I'll tell you which ones, as I say, in a second. Whereas last year, I was 80% in cash because every time I wanted to get in, all I could see was this falling and the momentum and the bull runs being short-lived and the momentum still pointing downwards. So I was just kept on each month thinking, okay, I don't want to buy more, don't want to buy more. So I had a whole load of cash, which, as you know, earns nothing. And belatedly, some healthcare and energy stocks in sort of May and April time, which, okay, helped save things a bit, but wasn't a great year for anyone. That's the flowchart I suggest anybody uses. Flowcharts are really good to use because it stops you going around in circles and stops you wasting time and allows you to go out and smell the roses. So I decide on how that S&P is doing, whether or not I'm risk averse or risk loving. If I'm risk averse, I'll just wait another month before I buy anything, or I'll average in, just slowly toe dip in. And this is where I sit at the moment with most of the stocks that I'm going to show you that I've bought. Now, when I'm fully ready, as I was in 2021 and who wasn't, and in 2020, then it'll be the filtered companies, which I'll show you in a second, and the quality ones. Volatility below 20%, please, because anything above that, particularly in this kind of market, you could find yourself losing 30-40% in a year on an individual stock if the volatility is 20%. And so below that, ideally, there might be some special situations, what I call special situations, where I will say it's high risk, volatility is high, they're smaller cap, but this is what I'm expecting, where I think there's more upside to downside. And I'll show you illustrations of those in just a second. Now, I don't think I need to tell you how fund managers destroy your pension. This is one of the reasons why I have my campaign for $1 million, which is all free resources on teaching people how to invest. Because one person got in touch with me on one of these kinds of webinars and said to me, Alpesh, my employer has put my money in a pension. And most employees don't even know employers do that and put it with a fund manager. They just think the magic money tree gives them money at retirement. And he said, it's Blue Whale. What do you think? So I thought, well, I don't know. I've not looked at them. So I looked at them. That was down 27.6%. I then had somebody, an IFA on Twitter, trying to convince me that that's not all bad. He said, well, maybe if he held it for 5 years. I said, he's down 27%, lost a quarter of his pension in 1 year, and you want him to stick with it for another 4? Oh, yeah. That says, well, he might only have put a little bit in. And I said, well, anything is too much in a pension where that thing drops 27.6%. And that's a fund. And these are typical fund managers. They'll advertise like crazy. And you might say, well, nothing wrong with that, Alpesh. It looks sensible. Might look sensible in 2021 or 2023, but in 2022, you just stood there and got pummeled while tech companies were punching you in the stomach and you just kept holding them. And you said, I'm only going to pick the mega caps, £100 billion plus companies. So you basically ignored 99% of the market on top of that. And that's what the fund managers do. These were, by the way, I've held some of these companies, not last year, with the exception of Microsoft, which I hold for the long term. Nvidia I've just bought for this year. You get the year wrong, as this Muppet did, and that's your pension gone. You don't need me to tell you all of that. And that's, like I said, why we have it. So we want more data, not stories. That's first lesson I'm going to give you. And it's this. See that in red? That's how we're going to pick the stocks. Whilst those companies, the same companies, have their stories which are written in black and sound really exciting. A biotechnology company focused on discovery, development, commercialization of medicine, address critical needs for people impacted by rare autoimmune and severe inflammatory disease. Sounds exciting. Don't fall for the stories. It's the job of the fund managers to spin your stories, for the Hargreaves Lansdowns and the AJ Bells to spin your stories. Go for the data. So we're going to look at how do we get that data so we can quickly find out, generating 100% cash return on capital, investor growing revenues at 40% per annum, forecast to increase 50% next year, but the share price is 45% below its fair value. That's what I want to know. Those are the numbers. The stories, I couldn't care less about. They sound exciting and, humans love stories, but don't fall for it, and some more. So these are some of the companies I'm going to show you that I've invested in, not because of the stories, but because of the data. Okay, so that's the first lesson, data. Secondly, we're going to pick low-hanging fruit. We're going to cherry pick, or apple pick in this case, low-hanging fruit. That means you're not trying to get it right for every single company. There'll be loads of good companies that your theory, and have one or two theories, and I'll share you mine, which you can copy, of why the stock should go up, and stick to those. Don't have 50 different theories. Don't shove everything into your portfolio like it's a garbage bin, okay? Instead, have one or two theories, pick the low-hanging fruit, and doesn't matter that there was a whole load of good stuff that you missed, right? So, for instance, poor theory, and I get people asking me this, hey, Alpesh, there were some really great big fallers last year. Are they worth getting into? So I listed some of the UK companies which fell the most last year. Here they are. Are they good to get into? The theory is simple. No. ASOS was in there. It's not for me. Sorry. Drop 90%. Could still drop another whatever more. Do you want to do it? Good luck to you. Not a theory. Too simple. Okay. Might be better if you want to develop a theory. Actually, what about the ones which haven't fallen so much and have also had some recovery? So they fell maybe 60 to 40%, and in the last 3 months are up at least 10 to 50%, and have a low PE and good cash flow and a low price earnings growth ratio. Well, I've marked in green for further investigation some of those. Okay, some of those for further investigation. We want the theory to be simple, yet a little bit more sophisticated than it's fallen a lot, and ignore the journalists and all the rest of it and their theories. They all have a hypothesis behind it. Find your own, focus on it. I will share you mine. The next thing you need to do, have a high hurdle rate. Like I said, for the UK, for me, it's 20%. For the US, just because the US does twice the UK, so I'm not going to take credit for, I'm better at UK stock, US stock picking. It's just it does on average twice as well. I have double that number. Okay, and I've missed the UK one because I've not hit 20. I've hit 18 and a bit, unfortunately, since 2004. Annualized. Okay, currently in my SIP, this is what I mean. So if I've got that hurdle, it's got to at least give me that kind of return, I believe. I can't guarantee it. If I could guarantee it, I'd be the richest man in the world, because I'd have a bank account which I'd offer to other people saying guaranteed 40% per annum. So I want the Eli Lillies. That's what they have to look like. Okay, but I've just done a video on YouTube where I've explained why I've got out of Eli Lilly, despite the fact that it's done really well last year. A lot of people, they think, I'll keep that in my portfolio because it did well last year. Why would I transfer it out? Think of it like a football team. Why would you take your star striker out? Well, after 12 months, I have to review, analyze, and everybody gets sacked, and they've got to reapply for their job to be back in my portfolio, because I want to pick from a universe of 10,000 stocks, the best CVs. I don't just let somebody stay in my portfolio just because they were good last year. So what? They should have been an over-ripened fruit, which has got overvalued now. I've sucked out all the returns I could in that period. Now I've got to bin it, not hold it while it rots in my portfolio. And it'll happen to a lot of you, great company, which then you think, oh my God, I've lost all those gains I had, and I booked the holidays off the back of it. It's a 12-month holding period, then everybody reapplies for their job in my portfolio. It is my son's inheritance after all, and that's the biggest discipline that I have, knowing that my son will be disappointed and my wife will be furious. Wish it was the other way around, but it's in that order. Best of 2022 looking toppy. McKesson was probably my best pick of last year. You might say, well, you're rubbish. Yeah, my best pick, Alpesh, went up 200%. Well, good luck to you. Fantastic. That was my best pick of last year. And it's looking toppy now. What do I do? Well, I've got to reapply. I've got to get the other stocks in there as well. Okay. Yeah, McKesson might be the Ronaldo of my team. It leaves rather than me leaving it. That was exited, didn't work out. Some of them don't work out. They don't give you the kinds of returns you thought they would. And one of the tricks that I use to get a quick, I look at the fundamentals, but just to get a quick analysis, I just want to see, is that monthly MACD falling or not, the monthly one? So this is the process we're going to use. I'm going to simplify it for you so you can do it. Like all of you, you will probably look at social media articles. You put all these stocks into some kind of funnel. Now, I have a more disciplined process than that. I don't just randomly look at name recognition, which is a worry because private investors tend to do that. I look at all 10,000 stocks, and there's many free online screeners which will allow you to look at all 10,000 UK, US, and all international companies listed in the US markets. Okay, I look at those notes for my SIP and ISA. Don't forget, right? I'm British. I want Americans working hard for me so that my pension goes up and I spend that money in Britain. So it's a patriotic thing to do, investing in those American companies. I have Americans working hard for me and I bring the money back over here. Now, with all of that, what are the filters? Well, as I'm going to show you, we don't just want to try and gamble on value or growth or dividends or cash flow. We need to tick all those boxes because we never know which is going to be the one the market wants. Also, it should give some degree of resilience that if there's a stock market headwind, and you're battling a downward market, then your stock shouldn't fall as far. Can't guarantee they're all going to rise. If I could do that, I'd just invest in one stock, the one that's going to rise. Hold for 12 months and repeat. 15 to 40 stocks, lower than 15, it tends to be too concentrated, too much individual stock risk. More than 14, you're probably not getting any further diversification out of it, unless, of course, all 40 are NASDAQ stocks. So you want to have some kind of 15 to 40 and some degree of lack of correlation between them. Don't forget, when the markets fall, everything's correlated to the downside as well. Okay, some of the questions I can see I'll answer as we go through. Now, how do I do that? And is 40% realistic? Well, 40 only for the US, not for the UK. 20 is more realistic for me in the UK, and I've still not perfected that because we're only, as I said, up to 18. Now, I know valuation is important, but it's not the only thing. We know valuation is an important factor in companies' share price rising, but it's not the only thing. And I don't need to look at every single metric because I've got better things to do than look at every single metric. So we pick a couple of metrics for valuation and we weigh companies based on those, and anything which are overvalued we get rid of. We know overvalued companies can go up and we know undervalued companies can fall. So we know it's not the only metric. We know growth is also important. Sales growth, profit growth, cash flow growth. So we look at that. We'll also screen, filter for dividends because we know dividend paying companies as a general rule tend to do better. And you'll turn around and say to me, XYZ doesn't pay dividends and is totally overvalued and has no growth and it's done well. Yes, but that doesn't counter my argument. My argument is I'm looking for a small group of companies which will give me my returns. I might miss a whole load of ones which shoot through the roof because they were on the brink of bankruptcy and some guardian angel came in and saved them and they went up 1,000,000%. Well, that's not what I'm after. I don't need that in my, remember, son's ISA, okay, wife's SIP, right? So momentum, yeah, we know trends tend to persist, but it's not the only thing. You can't look at that alone in isolation. So we tick the boxes on all of these things, and we want to try and have ones which have relatively low volatility distributions. You can look those up on, there's a website called Wolfram Alpha. You can find those if you want. And volatility under 20% as well. So there's a lot of things we need to tick the boxes on. But like I said, there's free screeners on the internet for private investors to do it. We use Excel spreadsheets, good old Excel spreadsheets, get the data onto that, and then screen through it. In fact, I'll be able to show you how we do that. That's what it looks like across all 10,000. And we need all the boxes tick green. And if they're not tick green, then I'll wake up at 3 in the morning. I'll come back to that a bit later on. I'll wake up at 3 in the morning in a cold sweat and think, oh my God, why did I pick a stock which had so much not going for it? Why did I gamble? I need the valuation and everything ticked off. That's slightly redacted because if I didn't redact it, my clients would shoot me. Those are some of the stocks out of 10,000 which did meet our criteria. Feel free to take a picture. I'll come back to it later on if you want. So which ones do I like? out of that list and extra? Well, I bought into Nvidia because it ticked those boxes, not because there was a story about ChatGPT and the need for graphic cards, and not purely because there seems to be something of a base, and not purely because the momentum seems to have leveled off here on the monthly MAC and looks to be rising, not simply because can it give my run rate of 40%? Yeah, and then some. So even if I'm wrong, I should be all right. But because of all those factors, value, growth, income, cash flow, all of those factors. So it gets narrowed down to that. So the story wasn't the reason. It was the numbers. By the way, a lot of what I say, it just so happens Warren Buffett's been copying for years. I don't know how he's got into my head, but he has. Now, First American Corporation, that also came through. Okay, not just because of the chart or the momentum, value, growth, income, cash flow, dividend deals. None of these companies are ever perfect. Even mighty Microsoft isn't perfect. They won't tick every box to the highest ultimate level, but they will tick enough. Comcast is another one. Full disclosure, I own these now. Okay, Nvidia, First American, Cambion as well. Did it hit my and I'll put on the chart, is 40% reasonable? And that looks in line with, in keeping with previous performance, current performance and trend, and looks reasonable. But it had also value, growth, income, cash flow. Equifax I own as well, so I own all of these. Will they all do 40? No, I don't think they will, because if they did, I'd be hung for witchcraft. Community Healthcare Trust as well. Intel, and it's fallen off a lot. That wasn't the reason. It was value, growth, income, cash flow, and a whole bunch of other reasons on that. By the way, if you want more of these little snippets, and they're completely free to get, when I buy these and people say, when am I going to get the updates when you're going to do the UK ones? My TikTok is now nearing 100,000 followers, and some of the videos get 629,000 views, as you can see there. So you can get onto my TikTok there. It sounds silly to say TikTok, but I'm a grown-ass adult saying TikTok. But yeah, it seems a popular way of, in a minute, people find it, because 60-second videos. My UK ones, I'm going to put on TikTok as I get through them, because we're still finalizing some of them, and I've shared them only with the clients. And so before I make some of them more public, I'll put it on there a bit later on. But Hikma was one of the ones, for instance. That's the short list. You can see there, and you can see some of the companies and what they do. I don't know, you might be able to guess it. Provides packaging and automation solutions, healthcare, pharmaceuticals, food and beverages sectors. Well, they're trading at 48% below estimate fair value, earnings forecast to go. But we're finalizing some of those, and I'll share more of them. But Hikma, I can certainly share from the UK now. And I'll post more on my YouTube channel as well as we finalize the videos. And once I'm assured that, yeah. So how does it work out when it's good? When it's good, this is one of the best performances we had. It was 12 months to end of November 2021. Well, of course it was, Alpesh. It was great for everyone. Yes, it was. We had a tailwind, like a pilot flying from New York to London. He got there in 4 hours because he had a whole tailwind. But it also taught me to be somewhat humble, believe it or not. And Simon's probably spitting out his tea at that point when I said it. I'll tell you why humble. If I was so good, I would have just put it all in Crocs and got my 208%. Not that good. All I know is that it would have gone up more likely than gone down. Did I know it was going to be 54%? No, if I knew it was going to be that much, I would have, as I've commonly said, I would have sold my mother-in-law on eBay and even put that money onto that and leveraged the hell out of it. No, I didn't know it was going to be 54%. I don't know which stocks are going to be the outliers. I don't know what the total return will be. All I can do is control the bits I can control, which is make sure they are resilient, quality companies. I hold them for 12 months and get out. And why 12 months? Well, if you look at what Crocs did after that period, you'll see why. Because it plummeted. So did Generac. Why did it plummet? Well, because it had got overvalued. That's our job. Pick it at the bottom, exit at the top to a fool, hopefully, because it's too expensive by then. And then don't stand there and watch it crash. So some important lessons, which reinforced our methodology, which is we don't have too few stocks because we don't think we're going to know which one of those. So that's why we have to have at least 15 to 40 stocks. And we don't, if we were so clever, we would have only had one and we would have leveraged the hell out of it. We're not that clever. All we did was just tick a lot of boxes. And if the market had a tailwind as it did, we did better. And that was it. Okay, so I don't want to over egg the pudding, as it were, on that. And why does that matter? This is why it matters. This is why part of my campaign is to get more people to invest on their SIPs and ISAs sooner. Let's say you do manage in the UK, or even with the US, let's say you only get 20%. You might say that's ridiculous. Well, it was 16.6 with the index alone over the last 10 years. Okay, and you start with 100K and you put in a little bit each month. Well, that becomes $1 million after 10 years. And I'm trying to encourage more people to put money in their SIPs and ISAs, even if they're only going to index track. Okay, put it in their SIPs and ISAs for that reason. That's what it looks like. Why don't people do it? Why won't you do it? Very simple reason. For the first 3 years, it just feels like a lot of money is not being spent on holidays and clothes and having fun and restaurants. It's going into a savings account and not much is there to look at. It's because who the hell can think? The human brain doesn't tend to think 7 to 10 years ahead. After about 7 years or 8 years, you're making about $100,000 a year, and you'll go, oh yeah, I know about all this stuff. It's compounding. Well, you're wrong. Compounding doesn't allow for the fact of human psychology, which is people don't like compounding because it's too far in the future. We've got a psychological problem with it, and it's recommended to do it. And people sometimes say to me, well, I've only got £1,000. What should I do? I said, well, at least learn how to open an account with an ISA provider or a SIP provider. And there's Barclays, there's Halifax, there's Free Trade. There's a whole bunch out there. I'm not going to recommend any particular one as long as they're regulated. Well, let's see, you've only got 10K. That's what it looks like. Even with 10K, that's my son's junior ISA. And yes, the first 4 years when he was born were good. Last year wasn't so good because mainly cash. So you'll have ups and downs. But the idea is by the time he goes to university, he should be somewhere up there, the lucky bugger, as well, sport brat that he will become. Because the ISA's maximum limits, I think, is about 10,500 or 12,500. I forget which. I'm going to answer questions now. I've put all this in my books, and you can download them for free on the links page as well. Not all the books. You can download some of them for free on there. And that's why I tend to do things for government as well, because getting this right for myself sort of drew attention to me as well. When do I sell? 12 months, then reevaluate. I also have another stop. If it drops 25% from the high point, then I will probably look to exit. Sometimes I might move that lower, but on the whole, it's a good rule to have. And I'll leave you with one thought, which is you guys, you can be better than overpaid fund managers. And you don't need to look at him. Me with my big mouth kept saying that in my columns in the FT. So the FT said, we're going to run a competition where we're going to pit you against fund managers, analysts, financial journalists. And I beat them. And that's when I turned pro, because then the money came for the hedge fund from outside people said, oh, bloody hell, that's Woodford. I mean, you might say, well, you just picked somebody rubbish. Well, you narrowly beat the bloody cat. They gave him, after building him up in 2004, they gave him £9 billion. If they're building anybody up too much, just be careful. Warning to Cathy Wood as well. Those are the links. You can connect with me on LinkedIn. All the stuff's free. Telegram channel is free, and I'll put my data on there. YouTube, TikTok, it's all free. The investing classroom is free. The bank store, my download of my books is free. It's all on there, and that's the campaign for $1 million. But the links to that as well are on there. I'm going to take some questions now. Simon, would you like to curate the questions? I can also, actually, what I'll do before you do that, I'll share, because I know some of you will be interested in the UK. So that's when I filtered the UK, and I really need to see greens right across the board. And there's very few which match. And by across the board, I mean right up to PEG. So I need to see those all in green. So the value growth income rating is my proprietary rating based on valuation, revenue growth, dividend yield. So you can see a whole bunch of names there. And I can't ever usually find UK ones. And in the FTSE 100, there isn't any. There aren't any which is green, including up to price earnings growth. You see, some get close, but they're not close enough. So what we've done is we've done some what I call special situations where they narrowly miss, like Entain narrowly misses. And I'll do that as a TikTok video or a YouTube video and say what I'm looking to get in or out of. And you might say, forget about it. Too much risk, but we didn't find that. And I'll share with you FTSE 250. And similarly, there's very few. You might say, hang on, there's Volution. Yeah, but it's a 30% volatility. You might be happy with that. I'm afraid I'm not. So you can see some of the data there on that. And that should give you enough food for thought. I hope I've not left anybody unsatisfied with what they're getting, with names, and you can take photos if you wish, and links to all that free material, and downloads of my books. I always want people to be absolutely delighted by the time they finish. Okay.
Fantastic. Yeah, Alpesh, thank you for that. A little bit of a sniffle today. I like that metaphor. All the stocks reapplying for their own jobs every year. It's a good maxim, isn't it? I know David Paul, who's following you with his vector-based system, is a proponent of that as well. Make sure you keep checking back. You go through the watch list. Let's have a look. There's a few questions, which is great. Lots of people in the room today, which is really good. The S&P broke out on Monday, the 23rd of January, upward break of a long-term trend line. Looks good for momentum for a final leg up. Sorry, I think that's a comment we had before.
Yeah, and I think he posted. I saw that he posted that just before I put the S&P picture up. And my fear with that is you're right, but it's not a big breakout, and it could just keep sliding lower. So that's why I'm cautiously risk averse. So I've started toe dipping with some of the stocks that I mentioned and what I bought, but I'm not going all in like I did in 2021. And I reevaluate. I do a weekly stock market update, which I post on YouTube as well for people to look at, and that's really expanded now. It's 2 videos because it goes on for 15 minutes. So it's 2 7-minute videos, which goes through the market and the individual bellwether stocks. I analyze those, so you get a quick update on, okay, this is what I think and where it's going.
Fantastic. Tax changes for stock dividends. Is this will be UK tax changes? Any?
Well, don't forget the ISA's tax-free, so is the SIP. The Americans, you'll fill in a tax form so they won't withhold your dividends. I think they shave something off.
Right.
But given the rate of returns we're looking at, I'm really not worried about a percentage point here or there. And the currency's worked in my favor, as it always seems to with the US dollar. It worked in my favor during Brexit because I had dollars instead of pounds, and it's worked when Liz Truss was prime minister. God bless her. That bounce back of the pound was just such a no-brainer. I kept posting it on my LinkedIn, kept posting it on Telegram, shouting at people saying, this is an opportunity to save your financial year. Just keep buying sterling, US dollar, and 30-year long gilts. But it was just stupendously no-brainer. Once it got
going with the euro. I mean, is it the euro that's weakening, or the pound? Is it? I mean,
I've not today or in the last week looked at sterling euro, so I couldn't really comment on that right now. On that, I've been more focused on cable because it was just such a no-brainer. So I'd have to come back to you and look at that in more detail on sterling and.
Sure.
I could say something about differential interest rates and likelihood of recession in Europe, but I've got a master's degree in economics. I can BS, but I don't think that does either of us a service.
Is that what led you into TikTok? Was that
Well, the TikTok thing was because in a minute you've got to get to the point, and you've got to tell them I like this stock for this reason, and you're not going to get 650,000 views if you can't get to the point instantly. It's also what we used to do when I had my Bloomberg show, which you remember, Simon. We were we know each other from back those days. And we even did some events, I think, at Bloomberg in the auditorium with you and Lisa. And at Bloomberg, we used to have something called the Alpesh Patel Minute, where I talk to camera for a minute and tell them what I think is happening with a particular stock or what they should buy. So we sort of, I wish I thought of TikTok back then and thought, hey, this could be huge, but no, it wasn't that clever. So it's just an extension of the TV stuff, but it's a great audience to teach to. And because it's free and there's no, you don't even have to put your email in. It's people can. There's just no hurdles. There's no friction to people watching, and you reach a good number of people.
Do you find that? I mean, is it generally a younger audience that are on there that you're?
It varies. I've got when I look at the metrics of it, because it will tell you the analytics of the on the back end of the age groups. I have got 35 pluses, 45, 55 pluses. I'm assuming the 55-year-old pluses are not looking at people dancing. I'm assuming they're on there for the educational side. I know TikTok wants to move more towards an educational platform.
That's a big assumption.
It's a huge assumption. But on the educational side, I mean, I've learned stuff on there about just presenting. I could sit back and think, I do TV. I know everything there is to know. I could be really sort of arrogant about it. And I've learned, actually, no, things have moved on. And they're sort of showing me stuff on, actually, do this, do that, do this, do that. And I'm thinking, actually, that works. That's sensible. So it is a bloody good educational platform.
Kuldeep, just asking for the link to the Google Docs. I guess that will be on your
alpeshpatel.com/. It's literally on the screen right now.
Yeah.
So,
Okay.
and when they go through that, they'll see. So, presumably, he wants the PDFs. So, there's a link on there. When you go through that, it gives you all the links to everything that I've mentioned, from YouTube to Telegram to TikTok to the reports. And then you click on the reports thing, and it'll take you to where you sign in to get access to it. It's not Google Docs. Somebody else thought this before. I didn't say Google Docs. It's on a platform, and you can just put your email in, and it'll give you access to it, and it tells you where.
Fantastic. Jay says, I bought NVIDIA because Nancy P did. Okay.
Nancy Pelosi. Yeah, this is a chap who probably is on TikTok, because there's a lot of this on TikTok, that you can see what the Congress people are doing and what they're buying and selling. And the idea being that those in Congress are having inside information or special insights or whatever else. And therefore, if you buy what they've bought, it's a theory. Like I said, there are theories. I'd stick to one or two simple theories and not have a whole bundle of them. Now, if that's a theory you want to go with, you got to ask yourself, okay, how trustworthy is that theory? How much sense does it make? And is that all I'm going to rely on? And that to me sounds too close to it fell a lot, so I bought it. So I don't think there's enough due diligence in that theory of buying a stock. The theory I like is, what's its valuation, growth, dividend yields? Every single box has to be ticked. That's the theory I prefer, because it should give me more resilience. Sadly, even then, it doesn't give me a guarantee that each stock I pick will go up. But at least it'll give me some. Somebody saying that link doesn't work. alpeshpatel.com/links. I'll put it on screen. Are you there, Simon?
Yeah, I'll just check it. I think it's working.
Works for me.
Yeah, it's working for me. Okay, maybe we just want to check the way it's typed in. I'll post it there again. Okay, great. I've posted a link for our summer school, Alpesh, if anybody wants to come and spend a couple of days.
We had an amazing time. So we did a summer school in Spain, because Simon lives in Spain, and my wife wanted to go on holiday in Marbella. And I, being Gujarati, if you know anything about Gujaratis, you know we're like the Scots, Simon, of the United Kingdom. So I said to Simon, I said, look, wife wants to go on a really expensive holiday in Marbella. Should we do a summer school? So we did a summer school, and we had so much fun, a lot more fun than I actually anticipated, because people spent a couple of days with us. I think on the first night we finished about midnight, but I think everyone was up for it. And it wasn't just me talking. It really was back and forth and chit-chatting and drinks breaks and giving you a heart attack, because we did part of it outside the outdoor pool.
Oh yeah, come with me, my disciples, out to the pool. Where
So much fun.
I heard from Chris. I heard from one of the young chap from Birmingham. Actually, he's getting on really well.
Good.
With his trading. So
yeah, I'm delighted
to see him again. But yeah, if anybody wants to come out, join us. That's we're looking at Thursday, Friday, 29th, 30th of June. It's a small group. Maybe 25, maybe 30 people at the most. I think that room can take us. Any more, it starts to turn into a seminar. That's not that sort of event that we had. It was a far more sort of informal couple of days. But we got through a huge amount of content.
Actually, we did over the 2 days, trading and investing, and also outside of that, the informal stuff. Kids ask, once you get 40% upside, do you look to take profit? No. The reason for that is I need some of the stocks which, like Crocs, went up 200% to make up for the ones which will have gone down 25% from the high point since I bought them. Now, it's unusual if a stock, the high point is the day I bought it, and then it dropped 25%, then I'd have a 25% loss. And you might say, well, why do you set that limit? Well, the reason is this. If you've got 15 stocks, and let's say actually, let's start with the first one. Let's say one of them drops 25%. Then your money, and I put money equally into each of those stocks, 1/15 of your money has dropped 25%. That means you've got a risk exposure to an individual stock of less than 1.8%. Okay, so that's the impact of that individual stock. I've never had a scenario where even in the financial crisis, where every single stock has dropped 25% from the entry point. So you're down 25%. And you saw Blue Whale were down 27%. So it's a process which the advantages of having the freedom to pick from a large universe and being and not being constrained by, oh, you can only pick mega caps or whatever else. The advantages of all of that has meant that you do better than the fund managers anyway. So it's fantastic.
Thank you for that. Okay, so that's the good. Do government policies play a part in your decisions?
No. What happens is all companies are a factory for making money. Okay, all companies have capital, they're raw ingredients. I don't care what they make in the factory. They convert that into cash and then eventually, hopefully, into profits and growing profits. Now, policies might have an impact in them doing that, but I can't work that out for every single company out of 10,000 odd. Let me just take you back to that. And this is why I think private investors end up spending too much heat and not enough light. You know, going through policies, trying to gamble on the Investors Chronicle article, which said, oh, there's going to be a shift towards green energy or clean tech. You know which sector did the worst last year? Clean energy. Can you believe it? You know which did best? You all know which did best. Oil and dirty gas. Okay. Thanks, government policy. That bloody helped. So I look at the numbers. What are they outputting? I don't care what, as Warren Buffett said, I don't care what they make. They might make sweets. They might make great technologies. But no. And if I had to try and work out, how am I going to work out government policy impacting every single one of these? You might say, oh, well, you focus on certain sectors. Well, that might be a tiebreaker. Once I've got, say, I've got two companies and one of them's in, I don't know, one of them's in pharmaceuticals and one of them's in something completely different, retailers, and interest rates right. I think, oh, tie break. But it'll have to be a tie break. So no, I don't try and, for all my degrees and all my know-how and knowledge, I don't actually use much of my brain, because the danger with that is you think you're smarter than everybody else. I'm not. I'm just using a simple process and filter. I'm not trying to say I know more and therefore I will tell you what the future is going to look like. All I'm going to say is I think my process is pretty sound, given that it's pretty obvious as well. Due diligence, tick every single box. Most people treat the stock market like a casino. They go in and they say, yeah, I think, it's going to be red. Oh, it's going to be clean tech. It's going to be growth. It's going to be momentum. I don't do that. I say I want to be the house. And the way I can be the house is I tick every single box of those companies.
What about starting capital then? I mean, is that something? I mean, this question it comes up again. What would you say is the minimum to be able to diversify a range of stocks in a portfolio? Is a reasonable amount that you need, given that you can only expect so much return?
Yeah. So let's say you've got nothing. Let's start at the extreme. Okay. Then at least open an account and just watch and learn, and for the time when you'll have more money. So I have a lot of people who are in their 20s and 30s, and they've got, let's say you got 5,000. What would you do? So the question really is, let's look at that difficult gray area. You've only got 5K, Alpesh, what are you going to do? Well, if I only had 5K, I might either just put it in the index tracker, S&P 500, for a long period of time, or I might say, do you know what? I'm going to have to extend my time horizon because I'm going to have stock concentration. I can't really divide 5K into 15 different companies. So I'll have stock concentration. I've got stock concentration. I might have to extend my time frame. If I extend my time frame, they better be the kind of companies which I don't mind holding for 2-3 years. So for me, you might argue with me, and this usually causes lots of arguments. I might say, well, yeah, all right, Apple, Alphabet, Microsoft, Amazon, I'll hold. Now, that would get me shot by most sensible people, because they say, you're telling somebody to do concentrated stock-specific risk with just 5K and put it into 4 different stocks or 5 different stocks. Are you nuts? Yeah, that isn't sensible. So I'd probably say, you'd have to then say, well, I'm doing it aware of the risk that I'm going to have more money later. 5K is not my life savings. I'm going to be adding to it later. I appreciate that I'm going to hold it for 3 years or 5 or whatever. And they're the kind of companies I want. So you'd have to sort of fudge the rules almost. But the easiest bet usually is long-term index tracker if you've got very little and you think you'll only have very little going forward. But even with an index tracker, look at the chart on it. Look at how you could lose. As you saw, I showed you the indices. If I say to people, well, it's your pension, you're 60, if you put it in an index tracker and you lose 25% in a year, do you want to do that? And they go, thanks very much, cash. I'll just keep it in cash. Okay, so it all depends on what you need it for as well.
What about options? options and other derivative products?
Well, the risk warning with options, I mean, unless you really know what you're doing, treat it more like, you know, everybody probably has. Let's take your mass affluent. Assume people on here are sort of, you know, they're middle classy, so they're not stupidly rich, and they do have to look at their energy bill and mortgage payments, and you know, they do look at the price on the supermarket. So call it that, okay? Then with options, you might, like so many people like that, put 10% of your money into, I'll buy some Bitcoin, I'll do some options trading. It's only 10% my capital. And even 10% might be too much, and I'm not advocating it. Or they might say, you know, I'll put 1%, I'm going to Vegas, I'm going to blow a couple of grand at the casino. That's just ultimately how you'd have to treat it. Now, I trade options. Well, I used to trade options and then shifted to CFDs because they're also leveraged but more efficient. But call options, put options, I did it for the leverage, but I read every single damn book I could get my hands on, and I've done it for about 3 decades. Somebody coming new into it, I'm not confident in saying to them, yeah, go knock yourself out. There are ways of mitigating risk. You can have a portfolio, and you could write options against, let's say you've got $10,000 worth of Microsoft, you write $10,000 worth of options. So if you get called away, then you sell the stock, you get some profit, otherwise you'll receive the premium. It's still a little bit complicated. What I usually find is people get too carried away and then they start taking too much risk and they make loads of money consistently, and then all of a sudden it blows up because people naturally get greedy and they don't stick to that discipline. So for the moment, I have to say, live on air, stay away from it if you don't know what you're doing.
The kid says, I tell my kids they're time billionaires. Start now, get financially literate. I think that's a great, great phrase.
I'm brilliant. I mean, you know, they've got this ridiculous advantage of time. And the kid's absolutely correct, because where's that chart on that image? I think it was later on. Apologies, but it is ridiculous. And you know, I look at my son. I mean, I lived it. I borrowed £100 from my aunt when I was 12 years old. I had no silver spoon or anything, and I bought some. I lived through the privatization, so it was like shooting fish in a barrel. Anyway, I can't find it now. And yeah, so it is true that power of capital from when you're young, it's ridiculous. There it is. And you're starting at 0 in year 0, which I think when my son was born, it was 5K was the max in the junior ISA, and then they increased it to 12.5. I forget what the exact number is now. And it's, yeah, it'll be a weight off my mind. Now, some of you will be looking at this and thinking, yeah, mate, you say 12K as if that's just lying around, or I want to take that out of my salary and just shove it in an account for the next 15 years for my ungrateful little kids, and who knows how they'll turn out. But you don't have to use the whole allowance. Even if it's 1,000 and they get to monitor it and see what happens, it's something. It's just that getting the ball rolling.
Some great feedback. Thank you very much indeed, Alpesh. Totally agree. Simpler is better. Have a brandy, honey, and lemon. Yeah, okay.
Thanks, Aldi. I know.
I
totally agree. I have a bit of brandy last night.
I just substitute the brandy for whiskey in where I come from, but it works just the same. Alpesh, thank you very much. As always, thank you for your support, coming on to join us, give some insight into what's happening. We'll keep in touch, and stay warm and stay well. I'll talk to you again soon.
Thanks, mate. See you. Bye. Bye, everyone.
Thanks, everyone. Now we're going to end this session again. I'm going to pull everybody through into session 6 because we've got David Paul from VectorVest lining up, and he's going to tell us more. We're sticking with the stock market, not the Forex market. So we're sticking with stocks. I will see you in just a second on the other side.